Great, thanks, David. Thought I'd start off with this slide because I think it's appropriate for the planetarium, but also it really typifies what we're seeing in the markets right now. We're seeing some blue sky, but also some dark clouds, and we want to go over that tonight. So in order to see that, we're going to look at what happened last year in the capital markets, how the economy influenced what was happening in the capital markets, and then finally, what we see going forward this year and beyond. Looking at the S&P 500 last year, up a very strong, almost 13%. But you know, it was a tale of two markets. First half was negative, down over 8%, only to rebound very strongly in the second half, up 23%. If we were to look at valuation, this is on forward price earnings multiple. An average valuation for the market is around 15 times. Presently, the S&P is slightly below that. We would maintain that being that close, really the market's very fairly valued, which, given the rally in the market, is pretty good. A lot of that is due to the fact that corporate earnings have been very strong in the U.S., profit margins have been very good. So you've seen a very nice rebound in corporate profits. The TSX, same story. You see a very good return for the year, up over 14%. But again, a tale of two halves. First half of the market was down almost 6%. Second half up 21%, just like we saw in the U.S. Valuation, again, very similar. An average PE of around 15 times. Right now, we're trading slightly above that. But again, not that far off. We would say that this market is fairly valued. Now, you look at the bond market, again, it's a very similar story. You see the first half of the year, both Canada and the U.S., tracking very closely. You see bond yields falling. Second half, they're moving up. But of course, with bond yields, it's the opposite of stocks. When you look at a falling bond yield, that means prices are going up. So it's actually the opposite of what we saw in the stock market. You saw prices going down, and then you saw them, or rather going up, and then you saw them falling. And I think the next slide that I have, I think really shows that. If you look at this slide, the blue line here, and what this is showing, it's the trailing return on stocks represented by the S&P 500 and subtracting off the trailing return for bonds, such that when this blue line is moving down, it's showing people are buying bonds, selling stocks. You see bonds outperforming stocks. And what traders were calling this was the risk-off trade. They were trying to remove risk from their portfolio. Alternatively, second half of the year, you see that line moving up. It's people buying stocks, selling bonds. They were trying to add risk into their portfolios, and the traders called this the risk-on trade. Now, of course, everyone would like to buy at that point. But that's a hard thing to do because given the negative momentum of the market, it's more likely most investors are inclined to actually sell. And this will give you obviously the worst investment results. One of the things, and David alluded to this, what we try and do is build cash flowing, diversified portfolios. We're trying to take away that volatility from the portfolio so you have that more constant return to remove that temptation to sell at the wrong time. Now, one of the other things that can make sure that you don't sell at the bottom or buy potentially at the top is putting the return in the market and the action of the market in context of what's happening with the economy. And that's what we want to go over next. Now, one thing quickly, though, I want to point out is this movement from risk off to risk on happened very quickly. It was literally like flipping a switch. One day you're in the office and everyone's got the risk trade on. The next day you come in and the game has changed and people are taking that, they've got that risk on trade on. And it sort of reminded me of growing up as a youth playing road hockey. In the middle of the game, and it's a little grainy, but you're in the middle of the game, someone spots a car, what do they yell? Car. And what you do is you pick up the ball, you grab the net, you drag it to the curb, and you wait for the car to pass. And this is similar to what was happening in the capital markets. Specifically, traders yelled car, they saw that car moving down the road, they started selling equities, buying government bonds, they were moving to more riskless assets, they were buying long-term bonds, especially buying the U.S. dollar because the U.S. dollar was perceived as a safe haven currency, and they were selling commodities. Now, once the car had passed, you get your sticks, you drag the net back into the road, you throw down the ball, and what do? You yell, game on. And that's what traders were doing as well, and it happened very quickly. And when they were yelling game on, they immediately started buying growth caps, small cap stocks, the most risk sort of assets in equities. They were buying also junk bonds. Again, anything that would add risk to the portfolio. They were selling government bonds. selling US dollars. They wanted to get away from that safe haven currency and buying commodities because it was linked to growth in the global economy. Now, what I want to do with the economy is I want to use that visualization and relate it to what was going on in the US economy. So some of the things that was happening in the US economy related to that risk-on trade, and some of them was related to that risk-off or car trade. Specifically, some of the things that were risk-on was the US economy GDP growth itself and consumer spending, which were very good. On the negative side, the housing market and the employment market. So starting with the GDP growth, you can see from this line we had a very good recovery in GDP coming off of the recession. 2009, the economy contracted almost 3%, and we got it all back in 2010. So you saw that economy come back. This was perceived by people as being very bullish. Also in line with that, the National Bureau of Economic Research, this is the body that is empowered in the US to declare when a recession starts and when it ends. They declared that the recession that started December 2007 ended in June 2009. And unfortunately, they didn't let us know that until September of last year. But when they finally made that announcement, again, people saw that as a positive sign. They piled into that risk-on trade. Now, one area in the economy that was particularly strong was manufacturing. And you can see from here, this is a survey that's taken by the Institute of Supply Management of 300 purchasing managers in the US. And you typically, anytime the survey returns an amount, an index level above 50, it means that the manufacturing sector in the US is expanding. And you can see by these brown bars, it's been expanding since the middle of last year. In fact, in January, it returned 60.8. That's a very high level. That's traditionally a level in the 60s is associated with GDP growth of 4 or 5%. Now, that's not to say we're going to see GDP growth of 4 or 5% because manufacturing is shrunk to being only about 12 to 13% of the US economy, but it's still very strong. But one thing that is a huge part of the US economy is retail spending. And again, that has also picked up. As you can see here from this blue line, we've seen retail spending rapidly improve over last year. In January, year over year, up almost 8%. On a month-to-month basis in January versus December, not quite so strong, only up 0.3%. But it's, January was a very harsh month in the U.S. on the eastern seaboard. So a lot of that was weather-related. What we're seeing so far in February is very strong same-store sales. So we're seeing that carry through. It looks like the consumer is back spending in the U.S. That's good for the economy, and it's good for traders who want to put on that risk-on trade. Now, an area that moving to the risk-off trade, to the car, would be the housing market. Unfortunately, you can see the line dipping down again. It looks like the housing market in the U.S., it looks like it's double dipping, and that's obviously bad news. In November, home prices fell versus October, 0.8%, down year over year, 0.4%, so that's obviously negative news. Now, you could look at this and go, housing prices are down 30% from their peak. Surely they cannot go down any further. Unfortunately, that is not the case. If you look at this graph, the trend line, over the last 100 years, homes have gone up about 3.35%. And that trend line is that red line right there. And you can see the blue line is how much it's come down already. During 1997 to 2006, they went up over 19% a year. In order to get back to that trend line, they'd have to fall another 20%. So there's absolutely room for the housing market to move down, and we think it's in the process of doing that. The negative of that is already the implications of where we're at, and the number of homes underwater in compared to the value of their mortgage is extremely high. Right now, it's estimated about 23% of all homes with mortgages are underwater. That's over more than 11 million homes. If prices go down another 5%, so you don't have to go down that 20% line, just another 5%, you're adding on an almost another 2.5 million homes. Amherst Securities estimates that homes that are 0 to 20% underwater, typically about a quarter of them end up defaulting. If they are underwater by more than 20%, half of them default. Right now, there's about almost 5 million homes that are more than 20% underwater. So a lot of those homes, they're going to end up back on the market in foreclosure. And why that's a big deal is there already are a lot of homes up for sale in the U.S. Right now, the visible inventory of homes, so these are homes that are already up for sale is about 4.2 million homes. Based on present sales, that's about 15 months of supply. Really, a market is considered to be in equilibrium when you got about 6 months supply. So that's a lot of homes. But it gets worse because the shadow inventory is about 2 million homes. And a shadow inventory is homes that have already foreclosed, they're owned by the banks, but they haven't put them onto the market, or homes that are in the process of being foreclosed and are soon going to be on the market. That's about another 8 months supply. You add all together, that's 23 months supply of homes. So again, this is going to take a long time to work through, and it's definitely something that when traders look at the U.S. economy, it makes them want to take the risk trade-off, yell car, and head for the curb. Now, another area where you might be heading for the curb is the employment market. Now, this is showing jobless claims as the 4-week average, and this is good news because you see it trending down. On the week ending February 26th, it was about 388,000 new jobless claims on the 4-week average. At the peak last year, it was 650 a week. And so it has come down. That's the good news. We see that in the unemployment rate as well. In February, the unemployment rate in the U.S., 8.9%. That's down from a peak of 10.2%. So this is all very good news. The thing is, you have to look at that unemployment rate with a bit of grain of salt, because the participation rate, and that is the number of people, the labor force in the U.S. that wants to work or is working versus the absolute pool, has shrunk. The participation rate now is only just over 64% versus 66% before the recession. If we were to take that 66% and apply it to today's labor force, the unemployment rate would actually be 11.5%. So yes, we have added jobs, but that's not why you've seen that unemployment rate drop. It's because a lot of people have left the job market, more than likely because they've given up looking for a job. What's even worse is that a lot of the people that are looking for a job, they've been looking a long time. About 6.2 million people have been out of work for more than 6 months. So it's taken a long time to get those people back to work. And we think that actually makes sense when you consider where the jobs were lost. The U.S. lost about 8.4 million jobs. Look at where they lost it. Construction, manufacturing, retail, and finance. These were ground zero for the financial crisis. And a lot of these jobs are never coming back. So it's understandable that a lot of those people that are out of work for this period of time, it's going to take them a while to find it. I like this cartoon. If you can read it, it says, "Sorry, Smithers, you've been replaced by an iPad app." And I think that typifies the situation we've seen. Technology does displace workers. And you certainly see that in the manufacturing sector. In fact, the manufacturing output of the U.S. hasn't changed over the number of years. The number of people it takes to do it has gone down dramatically. The point, though, I would point out that, yes, Smithers has lost his job, but the guy who wrote the iPad app, he got a job. And that was a job that we didn't even know existed a couple years ago. So we will find new jobs. It's just going to take time.